It's been an interesting 2026 already, and it just feels like the invasion, the attacks on Iran kind of add another layer of risk to what's already been a pretty fragile market. So I am curious, before we get into portfolio management and what you should be doing, it feels like the first question that needs to be asked is what's really changed as a result of what happened over the weekend?
Yeah, I mean, I think it's too soon to tell exactly. I think you hit the word of the day, the nail on the head, which is uncertainty. Uncertainty has really been a staple, I think, for the last 18 months or so, is going to continue to be a staple. I think gold is reflecting that and has reflected that over the last year and a half. But I do think, listen, wars in general never really are disinflationary or deflationary. I think the bond market is picking up on that at the moment, whether that be because of the obvious oil and natural gas disruptions, or whether it be more due to supply chain issues. It's hard to make a case how what we saw over the weekend is going to lead to deflation or disinflationary forces. And
especially
I think,
going into it, there were inflationary concerns.
Well, that's the thing, is that, I think even without what was going on with Iran, you've been seeing inflation start to tick up pretty meaningfully. Remember, core PCE is what the Fed cares about. And core PCE bottomed in April of last year. You look at ISM input prices today, you look at the PPI data, it's all suggestive of higher inflation, not lower inflation. And so this just adds another wrinkle to that, which I think the bond market is getting right? You started off with the flight to quality and lower yields, and that quickly reversed course, and now you're seeing higher yields, and I think that's the right reaction.
Can we extrapolate this to midterms and in an environment where voters care about the economy, voters care about prices, they care about inflation, and what this war could mean for a change of control in Washington? Not at the presidential level, of course, but maybe in the House, maybe even some are saying in the Senate.
Yeah, I think ultimately what matters for markets is less politics and more what the trajectory is for liquidity and earnings. And so to the extent that, how does it matter to markets? I'm not sure the midterm elections even matter all that much. I think earnings growth is reasonably strong in the U.S. It's certainly expanding globally pretty dramatically. What happens with the midterm elections is not going to affect what happens with European earnings and emerging markets, ex-China earnings. I actually don't think politics are going to have a huge influence on rates either, which I know is probably maybe a controversial statement in and of itself. But I think the markets are smarter than what's going on with politics, and investors will be investors. And the midterms are going to prove to be much less exciting for markets than maybe what most expect.
What could be exciting in a negative way is some kind of crisis. And I just do feel like the drumbeat is expanding. Former Goldman CEO Lloyd Blankfein speaking in an interview with Citadel's co-chief investment officer about how he can smell a fresh crisis brewing and sees similarities, parallels to the mortgage crisis. And then it was just Jamie Dimon that we heard from about a week ago, and we're going to hear from him in just a moment too, live on our air, warning of parallels to the financial crisis. What are the major risks? Which seems like a stupid question coming off a weekend where we have seen the U.S. and Israel attack Iran, and we see again unease, unrest, if you will, in the Middle East. What are the major risks? And is it, we've seen credit spreads widening a little bit, like we see things percolating, and yet that doesn't necessarily mean crisis.
Yeah, I do think that the stage could be set for credit weakness. We've been saying that admittedly for probably a little longer than what it's taken. About 18 months ago, we started talking about the illiquidity risk with private credit. And we're starting to see that actually, happen over the last few weeks and over the last few months. I think absent from, Middle East tensions and sort of war, and I'll talk about that in just a moment, I think the credit space does pose a bit of a risk here. Not so much from mass defaults and that causing a recession and any sort of contagion similar to the global financial crisis, but more from the perspective of having these very illiquid products. And what do you sell when you can't sell what you want to sell? You sell what you can sell. And so that can sometimes beget a crisis in and of itself.
Who gets hurt in that process?
Well, I think certainly private credit holders, but also just credit markets in general. I think if that comes at a time where you have higher inflation because of geopolitical risk and higher rates, that can cause meaningfully wider spreads and credit risk as well.
Something that's not lost on us, and we talk about this all the time, is that this is happening at a time where people want certain people want retirement accounts open to private credit.
Yeah.
And the idea that, well, everybody should have an opportunity to invest in what many argue is an opaque asset class. How do you view that?
So it's interesting. Rich Bernstein, who you all know, and is of course the founder of RBA, wrote an interesting report several years ago about what sort of are the makeups of a bubble. And one of the key makeups of a bubble is democratization of markets. And I think that's what we're seeing here. That's essentially what you asked him, is sort of the idea of private asset classes within retirement accounts and these sort of things, alts and all this, in illiquid asset classes within retirement accounts is democratization, just like, the gamification of trading has been. And
well, I mean, at the end of the day, the people who I mean, and correct me if I'm wrong, Carol, but it seems like the people who want this in retirement accounts are the ones who sell it.
Yeah.
And the ones who, would benefit from a larger market of people or entities buying these assets.
It feels like there's a lot of money to put to work, and they're searching for more markets to put it to work. And
it's a good way of saying
that makes me a little nervous.
Yeah, I think you mentioned Lloyd Blankfein earlier. He had a good quote about this and how many of his peers out there have made substantial sums of money doing what they're doing, and now they're trying to even grow that more. And what's the real need for that? Those were Lloyd's names, words, not my own. But I do think that is an interesting point. But listen, I mean, this is an industry. The asset management industry is one where you get paid to grow assets and perform. Right? We focus on the performance side and let the asset growth take care of itself. But it's hard. It's easy to see how those can get those objectives can get muddled.
Michael, just got about 30 seconds here. This moment in time, how do you suggest investors should be investing? Should they be making adjustments, thinking shorter term? What's your thoughts here?
Certainly not shorter term. I think investors need to think like investors and think over the long term. Currently, we want to be underweight really expensive excess in the markets, investments that are driven by liquidity. We think liquidity will tighten more. That means basically underweight long duration assets, speculative U.S. technology, China we would put in that boat, and overweight shorter duration assets.